Hi, I'm Cassidy, and I used to work at a startup and it recently sold, and it was so exciting. And yet, my equity in it ended up being worth $0. And I thought I would talk about that a little bit. Not because I'm bitter, although I'll get over it. Anyway, but I wanted to explain how it's possible that your startup equity could be worth $0. And I'm once again not saying this because I'm like particularly angry about it. I'm bummed, of course, but because a lot of folks often ask me about startup equity in job offers, about the difference between different types of shares and what it all means. And I want to give you just some details about that. Now, for a little bit of history of just like my career history, I've mostly worked at startups. I work at GitHub now, hey, but before GitHub, I was mostly at startups because I think they're fun. I genuinely just really like working in that kind of move fast, break things, build things from the ground up kind of startup environment. And the first startup I ever joined was Venmo. I was early on at Venmo, and Venmo is way big now. And at the time, I joined at a really weird time where, long story short, I kind of instantly was able to get to turn my startup equity into PayPal shares because PayPal was like spinning off into a public company like a year into the point where I was working there from eBay. There's some funky things happening at the time. And something I remember that was very interesting when I joined Venmo is they said that they do RSUs rather than doing options. And that's something I wanted to talk a little bit about first. So, units versus options when you do startup equity. There's pros and cons. When you get options, that means that you have the option to buy equity into the company. And yes, it means you're spending your own money, but you're buying it at a super discounted rate where like a certain share at your company that you might join at the startup you might join might be like 50 cents. It might be nothing. It could be more. I've worked at some startups where the equity is like $15 a unit or an option, and then some where it's less than $1 per share, and you go with that. When you get units, that means that instead of you buying it, you are just given the value of that. You are just given that equity. There's tax implications, and I'm not a tax expert, and I'm not going to talk about that. But basically, units, you're just given it, and there's tax stuff you have to deal with. Options, you're given the option to purchase that, and then there's tax benefits to that after a certain point. Those are the differences. You will most likely get options if you get an offer from a startup. Now, once again, when you get those options, you have the option to buy equity in a startup. For a founder, it is a big deal to let go of your equity because you own this thing. And the more you fundraise, the more you build, the more you hire, the more you get rid of your ownership of this thing. And that is a hard thing to do when this is your baby. And a founder mindset is a really specific type of mindset. Now, once again, you're buying these options. And when you have the option, like and you haven't bought it yet, it's nothing. It's $0. It is absolutely nothing. You might have a cliff where you like can't actually buy your options until you work there a year, or it might be quarterly. You might vest like a big chunk every year or a big chunk every quarter, or like once you hit your cliff is what it's called, where you can't buy anything until your 1 year cliff. Then you can buy it and you vest like 1/48 of it for the following several months for the next 4 years or something like that. There's a lot of different specific things there. When I first got into the industry, I was basically told if you believe in the company, you buy your equity. That's just what you do. It's just, of course. And as I got older, I started to learn, ooh, it might take a long time for it to ever actually be worth something. With the exception of Venmo, because of the weird timing that I joined, the most I've ever made from startup equity is about $600, which is not nothing, but it's not life-changing money either. It's not great. And once again, one of the startups I just worked for sold, and that was a solid $0. So that is not an ideal thing, but it happens. So once you exercise it. Again, there's taxes. What exercising is you buying the option. And then once you have that, that is your equity in the company. That is the number of units that you own of the company. And eventually, if the company IPOs, if it's sold, if it sells, if it exits in some way, that equity is worth something. That something could be zero, or that something could be something. Now, I want to explain how mine was worth zero. When I am an investor, I get what's called preferred stock. And preferred stock means that it's like the preferential one, hence the name, and you get that and you get paid first. Common stock is the next thing. Common stock is everybody else. And so let's just say you're a startup that has raised $50 million and or has a valuation of $50 million, let's say, and I don't know how much you raised in there, and you have some percentage of that. If the startup exits at a valuation for more than $50 million, like let's just say it's bought for $75 million or something, then hey, everybody gets their money. It's great because it will hit that valuation and more. The investors get whatever they invested in at that $50 million valuation and more. So let's say I'm investor A and I invested $1 million, assuming that the company was worth $50 million. Weird numbers, but bear with me. Then if it's worth $75 million, or let's say $100 million, I would get $2 million back or whatever. You see the general napkin math there. I'm not going to go into too much detail on that. You get more. If the startup exits for less than that valuation of what people say that the startup is valued at, then let's just say, for example, you're at a company, it was valued at 50 million, but it ends up being sold for 30 million. Then all of the investors that invested, they get their money back, and everyone who has preferred stock gets paid as much as they can in the math of that, where let's just say once again I invested $1 million and it was valued at 50 million. Because it was valued at 30 million, I still invested only $1 million. It's still the startup only raised a certain amount. Let's just say they raised 10 million total at the 50 million valuation. I still get something. But everybody else gets nothing, or gets a very, very small amount. And it really depends on how much money is left, how that can happen. The startup that I worked for, I was actually talking with one of my old coworkers recently who now is a coworker again. And I was like, hey, we worked there, long time no chat. And he's like, did you see that the founder got 75 million and we got nothing? And I was like, yep, I did. Because the founder has preferred shares. And so the founder of our old startup got a nice hefty paycheck and we didn't. And it is what it is. That's the gamble that you make. That's the game that you play. It is monopoly money. It is a bet. It is an investment where you put the money in and you hope it's worth something. And sometimes it's just not. And that is a very real reality of it. But sometimes it is. And that is a pro where right now, because I'm working at GitHub and we get Microsoft stock, it's really nice that it's real. I love real money. What a concept. I've not had real I've not had real company equity in so long. I didn't fully understand how nice it would be to have real money. What a concept. Anyway, so I wanted to explain that. But then I also want to talk about how startup investors work and how investors work in general, because a lot of times people are just like, oh, VCs, they're just like the rich people. And that's not always the case. And that's what's interesting about it, and something that I learned later in my career, where I started getting interested in angel investing and I discovered what's called scout investing. Now, when you are at a VC firm, you are investing money into these companies. It's often not your own money. It's what is called LP money, limited partner money. Now, those are the rich people. So VCs, just like startups, do fundraising, and they'll say, if it's a small firm, they'll say like, oh, this is our fund 5. Oh, this is our fund 3, where they raised, let's say, $100 million to invest in companies. So they consult the family offices, the billionaires, the rich people, the celebrities, all of those people to raise money. And let's just say I am a VC doing this. I say, hey, I have a really good in with dev tools companies. I know founders, I know developers. And so I invest in companies that I know are a definite good bet. You should give me money and I will invest your money so that way you get all of those preferred shares and stuff. My firm gets it on your behalf. And then when the companies exit, we all get paid. And then there's what's called a management fee, where I would say, like, my management fee is 10%, 20%. It really depends on the firm. And so if you, a rich person, give me $1 million, I would get, or my firm would get $100,000 as like the management fee of that money, in hopes that we all explode with a bunch of different wealth. So that's how VCs work. They get the money from the rich people to invest, and they hope to become the rich people they themselves after that. Ooh, my lights just turned off. That means it's late at night. Whatever. Anyway, from there, there's angel investors. Those are often either wildly wealthy people or people who are just like, instead of investing in the stock market, I'm going to put 1K, 5K, 10K, 20K into a startup and do it that way. Angel investors do that. That is a thing. I have angel invested in a couple companies. With varying levels of success. And I do actually like doing that, but I haven't done it in a while because I got scared of spending my own actual money in that front. But what I way more often do, is scout investing. And that is where a firm says, hey, you know developer tools, let's just say, Cassidy, could you invest in developer tools companies for us? We're going to give you a little bit of the money that the rich people have given us. This is your allocation. You get your own split of the money and see how that goes. So for example, I've done scout investing where a firm gave me $100,000. They gave me an allocation of $100,000 to invest in 10 startups, $10,000 each. They were all like very tiny startups, and this was in like the big mega boom of like 2021 when money was flying all over the place. And I invested in those companies, and now we wait. And when one of these companies goes big, yay, I get 20% of the profits, and the VC that gave me that money gets 80%. It's kind of like an unpaid internship that might make money later, if that makes sense. You're investing in a future self that you hope exists. And what's interesting is, because investors are so used to things going well and not going well, and startup success stories are so rare, which is fascinating. I remember when I first did this scout investing thing, they said, of the 10 companies, we'll be really happy if you get 3 good exits. It's probably more likely 2. Which is mind-blowing to me, because that is a very bad grade. That is a failure. That is not good. But if you make a lot of money, you make a lot of money. And that $100,000 that they invested, and they kind of do a spray and pray to a bunch of different companies via me, where I tend to know something, that could turn into 200,000, 500,000, $1 million. You don't know until the companies go through it. And that kind of exit can happen early, but it's rare. It's usually a timeline of like 5, 7, 10 years. And so it's a really, really broad range. And it's an interesting world to have like dipped my toe into, where I'm still very interested in it. And I've advised startups in exchange for equity, and I've advised VC firms in exchange for carry, which is like equity in the VC firm. And it's been fun, and I like doing that, but it is a very different world than a big company. So all this being said, let's just say you want to get a job at a startup. If you do, chances are your salary won't be as big as it would be at a very large tech company. That's just the nature of the beast, but you would get equity. It could be a good thing. If it exits, you could retire, depending on when you join and what that looks like. So many it depends. what you want to do is you want to ask some questions. First of all, what's the exercise window? There's such a thing as an exercise window where once you have like earned your options, let's just say you've worked there for 3 years, but your startup expects you to work there for 4 years. And so the equity that you get is slowly given to you via options for 4 years, but you leave at the 3-year mark. When you leave, you have all of these options on the table, the 75% of whatever you got, and you have the option to buy it. You can buy it while you still work at the company. And let's just say you work there for 7 years, you can take your time buying it for those 7 years. Or if you leave the company, you usually have an exercise window. Some companies have a really generous exercise window where it is like 4 to 10 years of like you earned this equity, you have a lot of time to buy it because it can be expensive. Sometimes it's you have 30 days. You have 30 days to buy this equity, that's your exercise window, or you're done. Sometimes it's like if you've been at the company for 2 years, your exercise window is longer. It depends. So ask about the exercise window on equity if you were to work at a startup. Secondly, figure out the company runway and roadmap as much as possible. Runway is how long the company has until it runs out of money. And a lot of times startups will be just like infinity because we make money and we're a profitable company. What a concept. Sometimes they'll say like 8 months, but we're planning on fundraising. We're working on it now. And so that should extend. That's a nerve-wracking thing, but it's something that you should know. Company roadmap, it's helpful to just know where the company's going and what they're doing. That's less on the equity side, but just in general as you're making these decisions. But then also company valuation, where based on the most recent fundraise, whether it's a pre-seed, seed, series A, B, C, D, every single time there's an increase in a letter, the company has more investors, but also a higher valuation. Your shares, when it's like pre-seed and seed and maybe A, tend to be pretty cheap. Less than $1, maybe up to like $5. Once you start getting into Series B and C territory, your shares might be like $15 or $20 or something like that. It's still a good deal relative to what your shares might be worth later if a company goes public or sells, but it's a big if. And so you want to know, what is the company valuation? What is the actual value of your options? Were you to exercise them today? And were the company to be successful? And just timelines overall. It's good to know. So anyway, that was a very, very broad overview, and I hope I didn't bounce around too much to help you hopefully understand how all of this equity stuff works. It is interesting to witness and see, and I love seeing friends who have made it big on these kinds of exits, and I'm genuinely happy for them. Sometimes you want to do the safer bet with the larger company, and I fully get that, and I particularly get that now as I am in that situation. But I wanted you to know about it. If you have any questions, please feel free. I'm happy to clarify this, make another video, or just answer your questions in the comments below. I'll talk to you later. Bye!